Now we're ready to choose the futures contract that we want to trade. Over here, we can find all the available future contracts. But first, let's quickly go over what a future actually is. A future is basically a contract saying that we will buy or sell a specific asset at a set price at a specific time in the future. So for example, when we are trading a Bitcoin future, we're not really buying or selling Bitcoin itself like we would do in the spot market, but we are entering a contract saying that we will buy or sell Bitcoin in the future. So for example, when we go long on a Bitcoin future, we expect the price of Bitcoin to go up. So we enter a contract saying that we'll buy Bitcoin at a later date, but at a price which is determined right now and which is usually close to the current Bitcoin price. So let's say we go long on a future contract for one Bitcoin at a price of $25,000 per Bitcoin. On the delivery date, which is when the future contract expires, we'll have to look at the Bitcoin price to see if we actually made profit or if we've lost money. If at the delivery date Bitcoin is trading at $30,000 per Bitcoin, we've made a $5,000 profit because we have locked in the price of $25,000 per Bitcoin when we entered the futures contract. On the opposite side, if at the expiry date Bitcoin is trading at only $20,000 per Bitcoin, we have lost $5,000. Unlike in the spot market, future contracts also allow us to profit when assets are going down in value. So for example, if we expect the Bitcoin price to fall, we will go short on a future. So let's say the current Bitcoin price is $25,000 and we go short one Bitcoin. That means that we agree to sell one Bitcoin at $25,000 in the future. If Bitcoin actually falls to $20,000 until the delivery date of the future, we'll make a $5,000 profit. And if Bitcoin rises to $30,000, we lose $5,000. So with futures trading, we are basically speculating if the price of an asset will go up or down. In practice, we don't actually need to wait until the future contract expires to get out of our position. If we want to close our long position, all we need to do is open a short position for the exact same amount, and that will cancel out the long position, getting us out of the trade. The profit or loss is then equivalent to the difference in price between when we opened the long position and when we opened the short position. And even though we might enter a future contract about buying or selling Bitcoin or any other underlying asset, in practice, we don't actually need to buy or sell the asset itself. Instead, we can just use any available asset as collateral, also called margin, to fund our trade and pay up when we close our position. As we've already seen, for USD SM futures, that would be either US dollar Tether or Binance US dollar. And for CoinM futures, we can use these cryptocurrencies right here.